Okay, hello and welcome to On the Couch with Steve, a podcast where we help you navigate the often complex world of buying and selling real estate. We obviously focus a lot on the Ipswich market, but we're talking about, I guess, the whole economy. Now, today is the 4th of July. I'm Steve Athanates. I'm the owner of NG Real Estate, so big shout out to our American friends, special day for them. And of course, what's happened today is the Reserve Bank has made an announcement. I'll talk about that in a second. First and foremost, let's welcome Steve Beach from Stanford Financial. Great to see you, Steve. How are you?
I'm very well. Thanks for inviting me back.
No worries. Now, obviously, you know why you're here. This is our regular monthly visit. We know that an announcement has been made in relation to interest rates. What's happened?
And the RBA have put them on pause again for this month, as we sort of predicted last month. I think over the last few weeks, a lot of people have been up and down, whether they were going to pause, they were going to go up, there was pause, and it was up, and then it was pause. Even as far as this morning, it was probably still a 50-50 shot where most economists weren't.
Yeah, I agree. And I think lots of commentators some people have been saying no, other people are saying, oh, definitely yes. A lot of it's sort of revolves around unemployment. So we'll talk about that in a minute. But mate, you alluded to it. We both predicted.
I was going to pause.
We both predicted a pause for this month. So to all the homeowners out there, hooray! no rise, yay! So obviously we get to keep a bit more money in our pockets and obviously avoid some of that mortgage stress and pain. But we're going to talk about what's happening with the market now, mate. With the RBA's decision, a couple of key comments that would have been made through there. Obviously, most people at home don't probably sit down and study what the Reserve Bank says. What's our thoughts on what the Reserve Bank's thinking?
What they sort of talk about, I guess. The biggest one, probably the predetermining factor why they paused this month was May's inflation information came out at 5.6% versus a 6.1 expectation. So it's actually a lot lower than where we first anticipated. So there's definitely a lot more people holding onto their cash and not expending it. Now, keeping in mind, we don't have the full information through from June. And then like we sort of talked about last podcast, there is going to be a lot of expenditure and a lot of people, I guess, spending money through the end of financial year sales. Being in finance, we did a lot of commercial loans for small businesses and large businesses, writing off vehicles and tax and equipment and everything along those lines. So I guess I don't think we're out of the woods yet in regards to rate rises. So I think I still am probably predicting another rate rise next month. But the biggest thing that came out as well is productivity. So Phil Lowe was talking a little bit about productivity was quite low in comparison to the labour force market. So essentially unemployment is still quite low. So there's still a lot of people with jobs and everything along those lines, which is great. But from an economics point of view, he's talking about that they need unemployment to grow. So they're wanting essentially more people to do more work for less labour force, so which is not the greatest of comments. So I think he sort of indicated somewhere around 4% is where they're expecting unemployment to sit, with inflation sitting at 2 to 3%, which is, I guess, the happy medium for I guess an economy. But at that point, 4% unemployment rate in Australia would represent something like 100,000 unemployed people. So.
So over what time frame are they looking to see that happen?
I guess they're still not talking like, hey, we need to do this, next month or next week or anything along those lines. It's a slow, steady burn down into that sort of inflation rate. So we're still sitting at 5.6. They want it to be between 2 and 3%. So I guess the anticipation was that we would be at an inflation rate of around 4% by the end of the year, and then sort of to slowly I guess, narrow landing into that 2 to 3% by the end of 2024.
Right. So people have obviously experienced a lot of mortgage pain. Obviously, cost of living's gone through the roof. Now, potentially, they're saying that like quite a lot of people, 100,000 up to 100,000 people, could effectively lose their jobs. That's not great, is it?
No, it's not kind of the comments that we wanted to talk about, but I guess this is the reality of life. And these things do take impact into keeping a steady and strong economy. Otherwise, we're going to continue seeing more and more expenditure. We're going to see cash rate continue to go up, and it's eventually no one likes to talk about the word recession, but like that's a couple of comments that we've had recently from calling up our clientele, and I've got a team of analysts and associates calling clients every day now, just saying, hey, how can we help? There's been rate rises, cost of living's going up. We're here for you. What would you like us? Is there anything that we can do to take off that burden? So,
okay, we'll steer clear of the R word. We'll stay away from that for a minute. Now, we were talking off air about what we're actually finding on the ground, and obviously you said leading up through June, you've probably lent a lot of money. People have spent a lot of money, instant tax write-offs and all those sorts of things. But what we're finding even within the real estate market is that there's a lot of buyers out there. Okay, there's half as much stock as there was 12 months ago. There's still a lot of buyers, and so much so that we're now starting to see investors coming back into the market who are saying, hey, I've still got money and I actually want to buy another property.
So that's what we're seeing a lot of is anybody that bought at the start of COVID or even just own a house prior to COVID, with property prices increased by more than 30% nationwide. Yes, we saw a little bit of a downturn in the market when after sort of, I guess, the first announcements of rate rises in May last year, all the way up until about November, December, which we saw, I think there was about a 6% property price fall. But just this year or just last month and alone, the property market nationally went up 1.1%. I think Brisbane was at 1.7 or 1.3%. Over the quarter, it's 2.8% nationally as well. So most of the major cities are still seeing quite a lot of property growth. I think what you sort of said before, there's not as much people of selling of houses, but definitely there's still a lot of people out there buying. I guess with the high rent that's available on a lot of properties at the moment. So usual story, supply and demand. If there's not as much supply, the demand is high, so people pay a lot higher for it. So, which is an issue, I think, looking forward is I live down the Gold Coast and I guess a few mates of mine who are still in the rental market. I just keep talking to me about, Steve, I'm still seeing $50 to $60 weekly rental rises, is where last year they were seeing $150 rent rise per week. So we are seeing a lot more people going, well, should I use some of that equity that I've got in my house to leverage and buy a investment property? So start building that property portfolio. Yeah,
for sure. Look, and like on the ground, what we're seeing as real estate agents is that because there is half as much stock, okay, we're still getting really strong numbers at our open homes. It's very common to have multiple offers. I sold a house on the weekend where over the course of 3 days, I did a midweek open home and then I did an open home on a Saturday. We would have had anywhere up to sort of 28 groups through that property in less than 5 days, and we ended up with at least 6 offers, and I could have kept going if I had left it open, but we started with a sale price in the sort of $775 range with offers over, and we ended up well over $820, so $50,000 over asking price. So all I would suggest is that there's still a lot of confidence in that property market, and I guess for people who are sellers, what's the advice to them? The market is still going up. It's
still strong.
So it's a great time to sell. For buyers, what are we saying to them? Okay, maybe you should buy now because prices are still going up.
And that's a big thing that a lot of people were talking about, and it's still being thrown around in the media. They're calling it the COVID cliff or the mortgage cliff, where we're seeing a lot of people that got into the market or refinanced in the market at sort of 2% interest rates. To be honest, interest rates are pushing towards that 6% mark now as a variable rate. There are some specials in regards to fixed rates in the sort of middle fives, depending if you want to take it over a longer period. I guess that's hedging your bets of rates aren't going to start to come back down next year, which is, again, a lot of economists are predicting that the cash rate may peak at about 4.6, currently sitting at 4.1, and drop back down to about 3.1 by the end of next year. So
would you say to people, like I'm personally not a fan. I wouldn't lock in for, say, 3 years even at a 5.5. I personally wouldn't do it. But obviously that's only my personal opinion. But what do you think about these longer term fixed rates?
I me personally, my fixed rate's expiring at the end of the year. So these are sort of some of the decisions I'm going to personally have to make. I sort of said to my wife, if I can get a fixed rate under 5%, I'd probably consider fixing. But I think if you're still over 5% at this point in time, I'm not.
Chance it.
It is gambling at the end of the day. You're flipping a coin. We're predicting if the rate's going to go up or down. But personally, I would stay variable and ride out the storm and then just sort of see what happens next year. You can't say 99 out of 100 economists are out there are all predicting rates are going to go down next year. Based on that sort of information, you would go variable and then just wait to see
what happens.
So the cash rate for essentially fixed rate market hasn't moved this month. So we're slowly seeing the fixed rate increase along with the variable rates. We are starting to see a little bit of decrease of fixed rates on the longer term. So your 3, 4 and 5 year fixed rates are starting to come back down, which is almost a clear indication that banks are expecting rates to go back down.
That's what I would have thought. Now, mate, we could obviously talk about this all day. It is a super, topical subject. People want to know about it. There's a lot going on. Mate, I guess it's prediction time. You've mentioned earlier that you think we will get a rate rise next month.
I'm predicting a rate rise next month due to the June information that's going to get released at the start of August.
Yeah, look, sadly, I'm going for 3 in a row. I was right the first time. I was right this time. I think there's going to be a rate rise too, just based on the data that we're seeing. A lot of the chat is obviously around unemployment and the desire to lower inflation. Yep. So, unfortunately, for the punters out there, I personally think we will get one next month. We've had a little reprieve this month, which is fantastic news for everyone, but I think we're both in agreement. We both think next month we will see a rate rise.
Yep.
Okay, all right. Well, to finish on that note, to everyone out there, thanks for tuning in to hear and see more of On the Couch with Steve. Please subscribe to the link below. Special thanks to our guest Steve Beach, one of our regulars every month. You'll be back again next month, mate. Yes,
yes, I'll be back definitely.
Beautiful. Thank you so much. Now, if you have an opinion about what we're talking about today, please reach out to us. We really want to hear your thoughts, so please don't be shy. Please stay tuned for more On the Couch with Steve.